Hello, everybody. This is Yard Denny. Thank you for joining me. We have a nice group of folks here. Appreciate you taking some time out of your day at the beginning of the week here. Lots to talk about. Let me start out by telling you a little conversation I had with my gardener over the weekend. He came to do the annual cleanup, and he said to me, I said to him, "How you doing?" He said, "He's doing okay." I said, how you doing? I said, I'm all right. He said, I said, how is things affecting you? Things are kind of crazy around the world. He said, yeah, he's having a tough time getting seeds and fertilizer. Fertilizer I wasn't that surprised about, but seeds I was surprised. And he said, yeah, Russia apparently exports a lot of seeds. And of course, fertilizer has been very much affected by what's going on between Ukraine and Russia. That's hampered the production of fertilizer. So right here in my backyard, the geopolitical events around the world are showing up as a shortage of seeds and fertilizer. Well, there's certainly no shortage of shortages. We're seeing them everywhere, and looks like it's not going to get much better anytime soon. We have seen some of the macro indicators suggesting that supply chain disruptions are starting to abate. But just as that started to happen, Russia invaded the Ukraine, and that's led to some issues with the supply chains around the world. And it's also led to a big surge in commodity prices. Then China is the Chinese Communist Party is a nightmare. And right now, the nightmare that they're imposing on their people is in Shanghai. They've got the city of 25 million people or so under lockdown, and they're actually separating kids from their parents. This is, I guess, what authoritarians do. But the government is desperate to achieve its COVID zero policy, which is I'm no epidemiologist, but I've learned a lot over the past 2 years, and it seems to me that they've got a terrible vaccine. The vaccine just doesn't really work. They vaccinated everybody, but their homegrown vaccine doesn't work very well. I don't know why they're not buying from Pfizer or Moderna. Those vaccines seem to have worked remarkably well. And maybe it's a face-saving issue. But then on top of all that, I think we all have become epidemiologists and perceiving that there is something to be said for herd immunity when it comes to viral pandemics, that if enough people get exposed and get over it, then that's a very effective way to make a pandemic go away. So you vaccinate the people who are most vulnerable, and anybody else who is willing to be vaccinated, and everybody else has to go through herd immunity. But the Chinese government aren't doing it that way, and that's led to a real disaster over there, and that can it will affect supply chain issues over there clearly. And then we've got, of course, the Fed. The Fed, I guess I'm making a list of things that we're all worrying about. We got the Fed having last week turned much more hawkish than people anticipated. I guess it shouldn't have come as a surprise, but I think what really shocked everybody is when the doves really started to squawk like hawks, and the market almost immediately kind of repriced what could happen in terms of Fed tightening instead of leisurely 25 basis point increases. Remember when Fed Chairman Greenspan did that and was called measured increases? Now the market seems to be discounting the potential for 50 basis point increases, maybe not just one, but a series of them, getting us more quickly to 2.5% on the Fed funds rate, which seems to be their perception of what the neutral rate would be. So they want to get there, and they've indicated they might have to overshoot it for a while just to make sure that they bring inflation down. And so 2.5 to 3% on the Fed funds rate now, I think, is pretty much the conventional wisdom of where this is all heading. So why in our right minds would we want to be in the stock market? Well, we certainly don't in our right minds necessarily want to be in the bond market. The bond market certainly is finally behaving the way I thought it was going to behave last year, when inflation started to go up above 2% in March of last year, got all the way up to 7.9% on a CPI basis in February of this year. I would have thought that we would have been moving to 2% and 2.5% much faster, but we're there now. And benefit of hindsight, it's pretty clear that $120 billion per month of purchases by the Fed of bonds is one of the main reasons why the bond yields stay down. But the bond vigilantes are back on the saddle again. They're riding high, and they've pushed this bond yield up to 2.7%. I think it's probably going to go to 3%, but that might be it for a while. A lot of people actually bought bonds last year. They rebalanced out of stocks and into bonds, and obviously there's some pretty substantial capital losses, I should say, in the bond market right now. But let's go back to the stock market. With what's going on in the bond market, with the 2-year yield having shot up in a vertical fashion, what's the case for stocks? Well, I guess first and foremost, you have to believe that despite all the craziness that we're seeing here, we're not going to get a recession. Now, clearly, the yield curve has gotten some people convinced it's going to happen soon. Others, like myself, not so convinced. A lot of leading indicators still look pretty good. The consumer confidence is very depressed, and that's of concern. But on the other hand, we just saw that in February, consumers borrowed $40 billion just during that 1 month. Some of that was student loans. Maybe if Biden's going to forgive or extend everybody's payments forever, student loans look like a pretty good deal. Maybe that's part of it. But we also know the car prices have increased substantially, so people have to borrow more to buy cars, and revolving credit has increased. So consumers are still showing signs of having the will to spend and having the means to spend. It's true that wages are being almost completely offset by prices, but we've seen some very substantial increases in the number of people working, initial unemployment claims, which, by the way, is a component of the leading indicators along with the yield curve spread. The initial unemployment claims dropped down to 168,000. I mean, it's the lowest in decades. So the labor market remains very tight. Liquidity is still plenty out there. There's, again, I've said this over and over again, and there's something like $3 trillion of M2 liquidity relative to where it should have been around now, based on just extrapolating the trend of liquidity of M2 prior to the pandemic. Then we've got the CFO put, which we've discussed in the past. A lot of that liquidity is in corporate balance sheets, and corporations are generating record cash flow. So there's lots of money for buybacks and dividends and merger and acquisition activity. Then there's TNEC, not TNEC, New Jersey. I think I mentioned it, TNEC last time. TNA is there is no alternative. You know what that's all about. Well, TNEC is there is no alternative country, being that given all the geopolitical craziness going on around the world, it looks as though we've got some weak outlook, a very weak outlook for possibly a recession in Europe. I think the odds of a recession are probably 50% subjectively in Europe, and sooner rather than later. Whereas the US, I'd put it at 30% and more likely next year than this year in that context. But with the Chinese response to COVID, with the Ukraine war, the US looks like a safe haven compared to the rest of the world. And then the other argument for stocks is they are a reasonably good inflation hedge. We know that revenues of S&P 500 or stocks generally do in fact go up along with inflation, tick for tick. Question is whether earnings will do that, and then much of that will depend on profit margins. And our weekly indicators continue to show that the profit margins hold up remarkably well in record high territory. So companies, I think, are doing a great job of maintaining profit margins. If that's the case, then earnings growth will be the same as revenues growth, and that's affected by inflation. But then the question is the valuation multiple, and the valuation multiple fooled me. I thought that when it dropped below 20, it could continue to drop, but it got to 18. Now it's back up to about 19. Well, it got up to 19.5. Now maybe it's 19 with today's action. But to leave myself some leeway in terms of where this market's going in this volatile year, I've put our earnings forecast with a 16 to 19 multiple. And hence we get this wide range. Forgive me for doing that. I usually like to give you a point estimate, but it just doesn't make sense to give a point estimate for the end of the year under the volatile circumstances we're in right now. So I'm using 4,200 to 5,000 as the range for this year, and next year 4,800 to 5,700. So when you look at this range versus next year's range, this year's range versus next year's range, I still think we're in a bull market. I don't see a recession, though. Like everybody else, I've raised my odds of a recession. Well, I've kind of run out of time to, let's see, where is this thing? Oh, there it is. Let's see if we can share the charts real quickly. I've run out of time to do all the charts, so I'll just skip real quickly here. So again, we started out the morning briefing with a discussion of the world order, and it looks pretty disorderly. Right now, Europe doesn't look that terrible, but this is data through February for the volume of retail sales, and it looks like after all the volatility, it's still trending higher based on this trend. But let's see what happens in March, April, May. We know that confidence has taken a dive there. If you look at the overall economic sentiment indicator for Europe, it's rolling over. And again, this is March, so we'll see how this plays out the next few months. We know that maybe it's hard to imagine that things could get much uglier in Ukraine, but it looks like World War II is about to be moved from around Kiev and the south of the Ukraine to the eastern side. There's going to be some huge battles going on between the Ukrainians and the Russians, and that could be something awful. But the sentiment index correlates very well with real GDP growth, and it's heading down right now. Also heading down is this red series here with all the noise around it, which is the consumer sentiment indicators that come out with the ESI. And you can see that it's taken a dive, as you would expect, given the news. And it's closer to home for them, obviously, than it is for us. Look at this chart. This is German passenger car production. I mean, it just kind of taken a complete dive. There were some factors that brought it down here, but they never recovered. And part of that was the part shortages. And now with Ukraine, there's even more part shortages. And they're certainly not going to be selling any luxury cars in Russia anytime soon. Purchasing managers, China, looks like there are some already signs that the zero COVID policy of shutting down things is having an impact on both China's MPMI and non-manufacturing PMI. And the data is for March, probably going to get worse in April and May. This is spilling over to emerging markets. I mean, China obviously is contributing to the weakness in the emerging market purchasing managers indexes, but it seems like it's somewhat broader than that. It's really kind of unusual to see commodity prices so strong and emerging markets looking like they're quite vulnerable. Part of that's the Fed's raising interest rates, which is generally not good for emerging markets. The dollar is strong, which is not good for emerging markets. And then all this geopolitical commotion is obviously not good for them. So meanwhile, the global inflation situation remains bad. This is the OECD and the G7 inflation rates. It's not just a US problem, clearly, though the US seems to have a particular problem in consumer durable goods. We looked at the CPI for a number of regions and countries where they actually provide the data for the overall CPI, the core CPI, and then for the components of durables, non-durables, and services. And so this is the overall. You can look at it in your spare time. This is the core. The US really does kind of stand out relative to the rest of the world, but this is where it really stands out is in durable goods inflation. You can see we're at 18.7%, and all the rest are like in single digits. So I think this speaks to the likelihood that the US fiscal and monetary policy is overstimulated compared to the rest of the world, got a demand shock that created this tremendous demand for consumer durables. and led to the huge surge in consumer durables prices. The good news is they should start to moderate at some point here, though I have to tell you, it includes autos, and I don't see much improvement in the supply of autos anytime soon, though used car prices, according to the Manheim wholesale price index, may be coming down. I mean, it's just hard to imagine used car prices can keep going up 50% year over year. The latest data suggests they're going to be up more like 24%, and that's progress in the kind of world we live in. I'll skip some of these charts so I can leave some room. Oh, this is our not updated. This is our personal consumption expenditures chart showing you the headline and core and what we're thinking. And we're thinking 6 to 7%. Maybe we're too optimistic here, but we think it's going to moderate to 4 to 5%, and then 3 to 4%. We kind of doubt that it's going to be showing 2% anytime soon. And as we've discussed before, the improvement should be in consumer durable goods inflation, but the deterioration should be in rent inflation, which will be an ongoing problem for at least the next 12, maybe 24 months. This chart just shows that if you want to bring inflation down, all you got to do is cause a recession. Every recession in this chart going back to the 1920s has been associated with the drop in the inflation rate. The Fed is hoping to engineer a soft landing. It's not inconceivable that that could happen. And again, I see some moderation occurring, particularly in the consumer durables. Whether that's enough to really take the pressure off, I think, you know, the Fed right now is squawking. They're all squawking like hawks. But I think as soon as we get some indication that we're at an inflection point where the inflation rate is starting to head lower, I think some of the doves are going to start coming out again. And this Fed, I just don't think has it in them to do what Volcker did, which is to let interest rates go to levels that cause a recession. But look, they kind of surprised us last week with the degree of hawkishness among the doves. So we have to certainly appreciate that's possible. Here's that used car price chart again, the Manheim index down to 24.7%. It's a little volatile, so you know it could go up the next time around as it did just the past few months. But I got to believe this thing's headed lower for an inflation rate. Here's what I said about the consumer. They borrowed $41.8 billion in 1 month. A good chunk of that was student loans. But auto loans were in there, and so was revolving credit. Consumers still have a lot of savings left over, I think. If you look at personal savings and just add it up for the past 24 months, the number is $2.6 trillion. So that's a massive amount of liquidity that's available to put into the stock market, available to put into the economy, available to drive inflation higher than I'm thinking. Initial unemployment claims we mentioned, pretty impressive strength in the labor market. Now that's good news and bad news. Maybe the labor shortages are such that they continue to feed wage inflation, and that goes into price inflation and rent inflation. And we have this bad wage price rent spiral comparable to the 70s or worse, because I don't think we had a rent spiral the way we're likely to have now. On the other hand, I'm still counting on companies responding to labor shortages by spending more on capital equipment technology to increase productivity. And that's what saves the day in the next few years. With the rest of the Fed, I've come to conclude that of all the yield curve spreads one wants to look at, I've kind of got an interest in this 2-year Treasury yield versus the federal funds rate spread. Just want to see something here. Okay. And you can see that the 2-year actually does a pretty good job of leading the Fed funds rate, of anticipating where the Fed funds rate will be a year from now. And what I really want to see is I want to see the indications that the 2 years done going up. So it's starting to predict that the Fed funds rate is a year from now will stop going up as well. This is just the spread. You can look at that on your own. Some charts here on the bonds versus inflation, the conundrum of why the bond yield stayed so low relative to inflation. I think the answer is partly foreigners buying our bonds because their yields in Germany and Japan are close to zero. And the other part of it is the Fed's QE forever purchases. That all, the Fed part of it all ended in March. And wouldn't you know it, that's kind of liberated the Bond Vigilantes to saddle up. And they did so pretty quickly, shooting this yield up from 2% to 2.7%. Well, now that now that this relationship is working again, hopefully we can count on it to keep the bond vigilantes from pushing this up much higher than 3%. Everybody's looking at the long-term bond yield chart and saying, boy, if we get to 3% and decisively go above there, that's the end of the bull market starting back in the early 1980s. And you have to respect that. That's what the charts show. But I'm inclined to think that the bull market's over, but that doesn't mean we couldn't see the bond yield trade between 2 and 3% for quite some while, quite some time. In other words, just kind of forming a long base. And that's what I'm thinking right now. But obviously that depends on the inflation forecast that I laid out working out. Here's that long-term chart. And, to take your old-fashioned ruler and see that there is, in fact, a pretty decisive channel to the downside here that could very well be broken. But we thought that was the case here, and that wasn't the case. Maybe we thought the case that was here, and it wasn't the case. So we'll see how that plays out. Of course, one of the nightmare scenarios here is that rates do continue to go up, and that the federal deficit just starts to become more and more net interest payments. And take a look at this chart that just shows what the publicly held debt is, and what the interest costs are at 1, 2, 3, 4, 5% interest rates. And right now, the Treasury is paying about, on average, 1.6%. With rates rising so rapidly, it's clear that this is going to be a rapidly rising component of the deficit. Stock market, same old, same old. The forward earnings are looking great, and they do, I think, reflect inflation. But the real question here is going to be the valuation multiple. And the real question, of course, is recession. If we're going to have a recession, then earnings and the PE will take a dive, as they did here. If we're not going to have a recession, then we can have these corrections, which are PE led, and then panic attacks, if you will. This one is going to be a little bit more troublesome because inflation is more troublesome. Here's the valuation PEs for forward PEs, and you can read about that in the morning briefing. So I don't want to shortchange you, so let's look at some of the questions here. Let's see. Oh, good. We're starting. Bing is starting out with a conspiracy. Conspiracy theorist in me says maybe China using COVID to naturally fix their old age demographic problem. When it comes to the Chinese Communist Party, I wouldn't put any atrocious conspiracy. I wouldn't dismiss any of that. So it's I guess possible, but no, I think they're just screwing it all up. They screwed up their demography with the one-child policy, and it's just one kind of disaster after another. Autocracies, at some point, something happens and they kind of blow up. We saw that with Russia and Chernobyl. And for a while there, I thought it might be the Three Gorges Dam that was being overwhelmed by huge floods. But that held, and I'm glad it held. I wasn't rooting for that to break, but this COVID zero policy may turn out to really bite the Chinese Communist Party. I hope something gets them. John, do you still see U.S. real growth at 2% this year and next? Yeah, that's still the forecast. It's a stagflationary outlook, which means slower growth than we thought before the Ukraine war. So 2%. Look, I mean, at some point here, oh, Chloe, of course. It must be time for Chloe to go out because it's 11:23. If she starts barking at me, I'll have to let her out. But she got me distracted here. Yeah, so 2% growth, stagflationary growth, higher for longer inflation with slower growth. But at some point, before the end of the decade, I hope it's in the next year or two, we should see more evidence that the underlying productivity story really is coming through and shining bright. Rocco, hi Ed, why do you consider the 2-year yield a good predictor of the federal funds rate rather than the 1-year yield? That would signal 1.7% a year from now. I'm just looking at the chart. I'll take a look at the 1 year. I thought I did, and I'll see if that's even better. but I'll compare the 1 year versus the 2 year and see which one works better. But it just seems to me that the 2 year has been particularly good at predicting that. But I'll look at it. Thank you. Doug, what is your expectation for the long-term inflation rate, and why do you think inflation, including Australia, in Asia, has been so much lower than Europe and North America? Good question. I think the U.S. answer is durable goods inflation. I think it's also rent inflation. Rent inflation is up to 4%. I'm not quite sure what the weights of rent are. My wife and I like to watch HGTV just to see where people are relocating around the world and what things cost and all that. And always amazed by how low rents are in Asia, particularly in Vietnam. And looks like a pretty place to spend a month and kind of at least rent an Airbnb. But I think some of the things that we view as kind of basics, like rent and durable goods, are simply cheaper in other parts of the world. That's partly because they're still behind us in terms of the consumer curve. Their middle classes are still growing, and all it took was 3 rounds of checks by the Treasury helicopter money, if you will, and we got this huge inflation surge. But we're looking into kind of comparing the U.S. to the rest of the world, and did a little work in the morning briefing this morning. We'll do more and certainly look at Asia based on your prompting here. Thank you. Bing, past few U.S. trucking freight rates have fallen off a cliff. Do you think this is from resolution of supply chains or global slowdown reaching shores of the U.S.? Yeah, you're not the first one who's mentioned that some of the freight rates are taking a dive here. And it's, I mean, I'm looking at the ATA trucking index, and it still looks pretty strong. I'm looking at the sales of heavy and mid-sized trucks, and they're actually getting a little weaker. I'm looking at payroll employment of truckers, and that's at an all-time high. You wouldn't know it from the headlines. I see that Walmart's paying $110,000 for entry-level jobs in the trucking industry. So maybe some of the supply chain disruptions in the trucking industry are being relieved. Would be my interpretation at this point. But thanks for pointing that out. Jay, how to understand the divergence between Michigan consumer sentiment and low unemployment rate? Well, I'm glad you asked me. I have been talking about it a few times, so it's on my mind. And if you look at the consumer sentiment index, it's much weaker than the consumer confidence index. The consumer confidence, both come out monthly. We like to average them together and derive our consumer optimism index. But the consumer confidence index tends to be more sensitive to employment trends, and that's why it's not as weak right now as the consumer sentiment index, where the consumer sentiment index tends to be very much affected by inflation, particularly gasoline. So I think that's the explanation is, look, on balance, when people are getting jobs, it's good for them, but the rest of us who are employed just feel a little bit more secure in our jobs, but we don't feel like anything materially has changed month to month just because the unemployment rate has dropped. So there's a lot fewer people that are impacted on the margin by the labor market improving, whereas everybody's affected by inflation. And so the CSI tends to reflect that more. Robert, take a couple more here. Again, I like to keep this to half an hour to respect your time. And I wish I could get my pointer to work here. Let me just do it this way. Okay. Robert, do you think that the probability is greater of a recession in Asia than Europe? Good question. Well, if we're talking about China sort of being the epicenter of the Asian economies, to the extent that Japan and Korea and Vietnam, those other countries do depend more on what happens in China than maybe Europe or the United States. China looks pretty weak. Definitely looks pretty weak, and the COVID zero policy is going to make it weaker. So I would say that it's conceivable, but the Chinese Communist Party is pretty good at rigging their economy and certainly rigging their data. I mean, it looks like their property bubble is burst big time, but they're somehow patching it up and keeping it from being as horrible as the 2008 calamity was in the US. But they've got their problems. And so, yeah, I think there's something to be said that about the potential for Asia to be worse than Europe. But Europe is just so close to the Ukraine war, and it's about to get uglier in many ways. And the whole issue of energy costs and availability is a real issue. And I think their confidence, as we saw, is taking a big dive. So I think the global economy, generally speaking, is certainly showing a significant slowdown. And in tomorrow's morning briefing, I'll be writing about TNEC. There is no other country, and comparing the U.S. to the rest of the world again. I've got a couple more questions here. I'll take one more. Could lower freight rates be a positive sign that supply side imbalances? Okay, we talked about that. I meant the supply chain. Yeah, we talked about that. Okay, one last one from Paul. A long one. Let's see. Looks like the Fed is going to walk and chew gum at the same time with the announcement of the 95 billion month runoff. Obviously, a 25 million difference. I think you meant billion difference from the 120 billion per month purchase. Was there any indication of how long the runoff will last, or by how much? Well, I'm not going to read. It's a long question, but let me just. I know where you're going. I think. Yeah, this is actually an unsettling part of what the Fed's doing. It is trying to walk and chew gum at the same time. I would have much preferred that they just said, look, we're on course here to raise the Fed funds rate. We're going to be more aggressive about it, but we're going to hold off on the runoff on the balance sheet because it's too many moving parts at the same time. And we're still studying on how it might impact the financial markets and all that. So, but they won't listen to me, and they're doing both. So they're turning more aggressive and hawkish on what they want to do with the Fed funds rate. And then are they serious? 95 billion per month is what they want to let the balance sheet run off by. And this is after stopping buying 120 billion per month. So we're talking about over 200 billion per month more. Chloe's whining. So we're almost done. So we're talking about over $200 billion per month in securities that the Treasury market has, and mortgage-backed markets are going to have to absorb in the face of them raising the Fed funds rate. So good luck with that. I hope they don't cause a recession, but clearly I have raised my odds of a recession for 15 to 30%. Some of you may be thinking it's 50% or even the most likely scenario. Hate to end on that downbeat note, but let me cheer you up and say, look, I hope you have a great week. I hope everything works out for you. Stay happy, stay invested for the long haul. Thank you very much.